We believe one of the keys to successful investing rests with our own individual ability to overcome human emotions and basic human tendencies. Some of these tendencies have been defined and are part of the research umbrella we now call behavioral finance or behavioral economics. In this latest edition of LPL Street View, let's unpack one of those tendencies we call recency bias. This is the human inclination to place too much emphasis on experiences that are freshest in our memories. In the world of investing, it can mean assuming market returns or market conditions in one quarter or 1 year will continue into the subsequent period. So how do you combat recency bias? One way we believe is to constantly recall that financial market decision makers, even some professional investors, are prone to irrational behavior. It's human nature to be irrational at times, and perhaps surprisingly, even professional investors can fall victim if they are not careful. So given that we know market prices can at times vary materially from rational equilibrium, therefore extrapolating recent market returns into the next period can often be a mistake. For investors, it's a good idea to engage in some rational homework to assess if recent market returns are in line with developing fundamentals or if they have been influenced by irrational sentiment. Another way to combat recency bias is to adopt a contrarian investing approach. An individual adopting a contrarian approach often looks for market opportunities that go against consensus or against current market sentiment. However, one has to be careful of blindly adopting a contrarian approach just because. Here you have to do your homework as well. Paying close attention to price deviations from the norm can often lay the foundation for a good contrarian decision. Finally, and perhaps the easiest way to combat recency bias, have a plan. If you have decided to set aside tactical asset allocation in favor of a systematic, longer-term investing strategy, one that rebalances toward an out-of-favor asset class on a quarterly or annual basis, the effect of recency bias on your portfolio may be minimized. In fact, having a plan and sticking steadfastly to it may be the easiest and most effective tonic against various human biases. Regardless of your approach, we believe combating recency bias and/or other human tendencies is an important step toward the development of a formidable wealth-building strategy. Thanks for listening, and as we always say at LPL Research, allocate wisely.